Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis. A warm welcome to Money Talk on Tuesday the 11th of August. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 100 million customers across 13 emerging markets. In today's business and finance headlines, Iran Monday ruled out direct talks with the US for now, citing violations of an interim peace pact. Meanwhile, Donald Trump told Axios that Washington would probably wait for Iran's economic suffering to worsen before softening its negotiating stance. And that comes as Tehran promoted a hardline ex-commander as top security official, shaking up its highest decision-making body on national defence. Indonesian President Prabowo Subianto has nominated veteran economist Destri Damayanti to lead the country's central bank, a move set to ease investor concerns over the bank's independence following the sudden resignation of its previous governor. She will need to be confirmed by Indonesia's parliament before being appointed to her post. Her nomination comes after the central bank has come under growing pressure to support Prabowo's economic agenda. The Bank of Japan signalled a faster shift towards monetary tightening at its July meeting, warning that inflation risks are rising and that the pace of rate hikes may need to accelerate. In a summary of opinions from its July meeting released Monday, several board members argued that underlying inflation is now close to 2% and that the BOJ must place greater weight on the risk of an overshoot, particularly as the weak yen, high fuel costs linked to Middle East tensions and strong AI-related demand continue to push prices higher. Meanwhile, the Japanese yen has given up roughly half its gains following the joint yen buying intervention by the US and Japan last month, which was the first since 1998. The currency bounced from a 4-decade low, around 164 yen to the dollar in late July, to close to 155 following interventions by Tokyo and Washington, but it has since fallen back. The yen weakened by as much as 1% to 159.36 yen per dollar on Monday. The yen remains weighed down by wide interest rate differentials, mounting fiscal concerns, and elevated energy and import costs. On today's Money Talk, we're joined by Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Peter Kim, Head of Global Investment Strategy at KB Financial Group in Seoul, and in Washington, D.C., our US economics correspondent, writer and broadcaster, Barry Wood. And if you want to get in touch with me or any of my guests, then please go to peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks are holding near record highs as the focus shifts to US consumer price data due Wednesday for clues on the Fed's next moves. The S&P 500 index slipped 0.1% to end at 7,753. The Dow was down 61 points, or 0.1%, closing at 53,976. The Nasdaq Composite declined 0.33% to 26,605. The three major US indices are coming off their best weeks since April, and the S&P 500 finished last week at an all-time closing record. Treasuries gave back gains from the previous session. The 10-year yield was up 6 basis points at 4.71%. The yield on the 2-year note was up 4 basis points at 4.25%. In the currency markets, the US dollar index rose 0.2% to 99.75. China's offshore yuan weakened to around 6.75 renminbi per dollar on Monday, retreating from a more than 3-year high reached in the previous session. Spot gold settled 1.1% higher Monday at $4,389 an ounce. And Bitcoin was last seen at $64,100, down 1.4% over the past 24 hours. Asian investors renewed bets on AI shares after a month of volatility. Japan's Nikkei 225 added 2.1% to close at 66,970. Taiwan's TAIEX jumped 1.6% higher. South Korean stocks started the week in a lackluster mood. The benchmark Kospi index rose 0.7% to 6,300, and the decline from its June high now stands at 31%. Chinese markets tracked broader Asia gains after softer than expected US jobs data reduced expectations of an imminent Federal Reserve rate hike. Hong Kong's Hang Seng Index added 269 points, or 1.1%, to close at 25,937. On the mainland, the CSI 300 rose 0.2% to 4,702. Futures markets are pointing for small gains in Hong Kong. The Hang Seng projected to rise 0.1% at the open. And Japanese markets are closed today for a public holiday. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Well, plenty to get our teeth into there. So let's welcome our Tuesday morning guests. We have with us Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia up in Hong Kong. Morning, Mark.
Good morning and good evening, Barry.
And in Seoul this morning, we find Peter Kim, Head of Global Investment Strategy at the KB Financial Group. Morning to you, Peter.
Morning, gents.
And then over in Washington, D.C., as always on a Tuesday morning, we have Barry Wood, our US economics correspondent and writer and broadcaster extraordinaire. Morning to you, Barry.
Good morning, everyone.
Well, look, while you're here, I want to talk about the US jobs data that we had out last week. The payroll decline of 23,000 wasn't what was expected, but we did see a drop in the unemployment rate to 4.1%. So, Barry, give me your thoughts on what you are reading into this, because in some ways it wasn't too good, was it, with the payroll decline, but the unemployment rate was good.
Well, that's only because people dropped out of the labor force. And but 4.1% is a good number for unemployment, and but losing 20,000+ jobs is not. That does really, I think, reflect the fact that the economy is mixed. It's bifurcated. Some people are doing very well. Those who hold equities are doing very well. Those who have a pension, that's not a majority of the public. They're doing relatively well, but a lot of people in the bottom quadrants of the income ladder are doing poorly. And I think that's what is reflected. I think this is probably good news for Kevin Warsh. I think the new Federal Reserve chairman is probably delighted. He's not delighted with bad news, don't get me wrong. But this removes the expectation that interest rates would inevitably rise in September. Because when you get that kind of a weak jobs report for the month of July, and it could be the same for the month of August, that really takes the interest rate rise, not the certainty, doesn't take it off the table, but the certainty of a rise is gone. And I think that's why we're going to look very closely at the consumer price index coming in Wednesday to see if inflation is cooling, as the market tends to think it is.
Have we got to get used to maybe lower jobs growth than we've been used to in the past? Because we're sort of in what quite a lot of people are describing as a low hire, low fire environment. And maybe with so many people dropping out of the workforce, we don't need to create so many jobs as there used to be in the past.
I think that's correct. And we are in a different phase. And, you know, a lot of people on the radio, I've been traveling and listening to talk radio, they lament. So many of the commentators are mostly on the right politically, say, you know, people are just struggling. But others say that's not the case. But I do think there is that case to be made. They've been hurt very badly by higher prices. So I think that you do have a lessening expectation, Peter, that the job market will remain hot as it has been. What did we get? 34,000 average for so far in 2026. I think that number is going to decline.
Yeah. Mark, what I'm interested in is where have all the workers gone? The participation rate now is down to 61.4%. That's off 0.7 percentage points so far this year alone. 1.4 million people have just disappeared from the workforce. Where are they going? What's happening?
I don't know if I can comment on what's happening in the U.S. I know what's happening here, where it's not nearly as dramatic, but it certainly is happening. I know a lot of people, especially people in their 20s and 30s and so on, that have just gone off the grid. They're working, but they're working in gig economy. They're doing special jobs, sometimes consulting, sometimes short-term things, sometimes trying to start a company or being entrepreneurial to some extent, but not doing the traditional working for companies. And some are even in an expensive place to live like Hong Kong. Some are finding ways to survive by sharing accommodations and so on. It's not nearly as extreme in other places, but we see some of it here. What happens though is just frustration because a lot of this is psychological impact. It's not as Barry said. Some people are better off than others, but it's maybe not as dire as sometimes the headlines suggest. But for a lot of people, they feel it is, or they feel it's not dire. They don't see where the upside is going forward. That's always been the case, but I think that's grown in the past year, 2 years, 3 years. Well, especially since COVID.
I mean, it's interesting, isn't it? Because private sector jobs declined in the data. We also had the ADP report, the previous, earlier last week, which also showed a sharp slowdown in private sector data. And that really measures people working at companies. So it does seem to highlight what you're suggesting, which is a lot of people are not really doing traditional type jobs. They're sitting at home in front of their computer, using AI, and doing things like that, which doesn't really register on the scale.
Well, many of the new members of, for example, the American Chamber are increasingly, especially the younger members, are those that can afford it, increasingly don't have, they aren't affiliated with a company. If it is, it's a 1 or 2 person company. I mean, it's always been the case to some extent, but it seems that percentage has grown. Should measure it sometimes, but that's certainly the indication. Of course, what happens for organizations like that, they come in, some do better than others, but a lot of them drop out, very quickly.
Yeah.
But Mark, don't you have a growth rate in Hong Kong of about 3%? And is that typical or is that atypical that you're seeing such slow growth in the labor force in Hong Kong because people are somewhat discouraged?
Yeah, well, I think that's a little atypical. It's actually higher than that. Probably growth is looking good, but again, Hong Kong is not unlike any of the other places we're talking about. It may not be quite a K-shaped economy, but it's in that direction. So there are some parts of the economy, especially younger people, the students that I teach, the ones that are graduate students that are about to go out in the economy. I mean, a lot of them are highly competitive, but they don't have the choice of opportunities that they once had. I mean, you can't generalize that much, but to some extent that seems to be true.
Peter, put this together for us. What does it mean for investors? What does it mean for the markets? Obviously, we saw after the jobs data, the odds of a rate hike decline for September, but they're still up for the rest of the year. And of course, we've got important inflation data coming out after the market close on Wednesday in New York. What does this mean for the Fed? What does it mean for investors?
So equity markets correlation with the bond market, macro data trends have totally decoupled in my mind. And we've been talking about this for a few years now about this trend, but it seems like it's getting worse. We have all the concerns of the geopolitical risks, the oil prices, deglobalization, but equity market, especially the U.S., is just continue to squeeze up. On the point of the job numbers, I'm now into the idea that we must throw away all these macro modeling that we've done in the past right out the window, because that in itself will help you understand the world a little bit better. I think the data that I've seen around the world, especially and Korea, is on the point about the participation of employment. Is that people are doing more part-time jobs, as people mentioned. The gig economy, sure. Freelancing is in itself now a massive part of the workforce now, which doesn't get registered. And even in the U.S. now, you have young people, not so young actually, in the 30s and some in 40s, going back to their parents' homes. And that's partially due to the demographic decline, but also the fact that the affordability of living in the cities or anyway reasonable for a young person who wants to retain their freedom and to seek different jobs and switch jobs makes them almost force themselves to go back to their parents' homes, which for some people I know is a positive, but for many people it's not, right? On the part of the Fed rates, I think I don't think that the US Fed's going to hike in any meaningful way consecutively that will derail this market, at least until the midterm is over, but even possibly for the rest of Trump's remaining term. I'm of the belief that the short-termism of trying to front load all the positives into juicing up the market as much as possible. I think Trump will do anything in his power to leave his term with a bull market. And that to me in the short term is positive, but over the long term, again, you're going to leave with a lot of baggage to sort out later.
Is that the right decision, do you think, if the Fed does decide we're just going to stay on hold for the rest of the year and maybe beyond? Is that the right decision? Because there are economists around who are saying the Fed is behind the curve. Inflation's been above target now for more than 5 years, and the Fed really ought to be acting.
Yeah, I mean, I think they'll hike when it's absolutely necessary, when there's no other choice. We're in an era of policymakers being reactionary rather than preemptive. And I think that's definitely the case with the new Fed chair.
Barry, if we're seeing this change, this big structural change in the jobs market that Peter and Mark have been describing, does that tame inflationary pressures to a certain extent with people, working freelance, working for themselves, living at home, presumably also because their wages now are growing more slowly, they're going to be tempted to spend less as well?
Yes, that is absolutely true. I don't think there's any doubt about that, Peter. There is a lessening of inflation. Now, that's really the trend line. Let's see what happens on Wednesday with this consumer price index number, because if that shows a decline in the inflation rate to 3.4, sure, that's well above target. But the important thing here is the trend. And I think the trend has been steady or upward, and now maybe it is shifted downward. And that has to do with what Peter has just said about interest rates. I don't think the Fed will be that slow, Peter, but I do agree that if the data is weak on jobs, if the economy is growing at less than a 2% rate, and so far that's the number that we've had, then I think the Fed will hold off in September. Everything is now pointed towards Jackson Hole. Jackson Hole is 2.5 weeks away, followed by a meeting of central bankers and finance ministers from the group of 20 in Asheville, North Carolina. So I think that we'll see. But I think you're onto something, Peter, when you say that, Peter Lewis, that there is indeed a kind of structural shift quite possibly underway here in the States.
Mark, what about Donald Trump? Once again, now is trying to fire Federal Reserve Governor Lisa Cook. He's issued a formal notice that is again considering firing her over long-standing mortgage fraud allegations. The US Supreme Court back in June ruled that she hadn't been given a fair chance to contest this. I'm wondering why he's keeping on doing this, because it is undermining the Fed, isn't it? And I'm wondering what Kevin Walsh thinks about it as well.
When you think of this, I think Barry is better placed to talk about this than me. It's certainly, just speaking from this perspective, people here in Hong Kong and elsewhere follow the Fed, and they had a lot of confidence in the Fed. This churn that keeps going on, and with the president intervening and the reactions, apart from the interest rates and everything else, it just makes people a little uneasy, more uneasy than they would have been in the past. Because this drama, we've had a little bit of over the years, but it's pretty new.
Yeah.
I really agree with what Mark has just said. Look, this is nonsense. When you strip away everything, it's nonsense. The Federal Reserve is an independent institution. She can be fired for cause. Nothing is explicit beyond that, for cause. Now, what is she accused of by the Trump administration? Of misleading and filling out an incorrect statement on a second mortgage, on a second home, 10 years ago. The Supreme Court said, as you just said, Peter, she wasn't given enough time. Good heavens. I think this is just the Trump administration saying, we don't let go. We're like a small dog that has yapped and reached out to bite someone's pant cuff and won't give up. And I think the Trump administration knows this isn't going to go anywhere. Lisa Cook will stand her ground. She won't be intimidated. But as you say, Mark, it does damage.
Oh,
Yeah, of course it does. Of course, it's the reflecting pool approach too.
Exactly. Now, isn't it interesting when you look at that? This is classic Donald Trump. The reflecting pool. He was cross at his prosecutor, who was in fact a Trumpist, saying, because she had this fellow, but then went to the White House and said, hold on, I haven't got enough stuff. I can't make this prosecution stick. So she drops it, explains all that to the president. The president berates her, Janine Perot, and then now says in the last 12 hours, oh, well, there was a problem. But the fellow was wrong to reach into the pool to take something. This is classic Donald Trump.
Okay. Well, look, this story is going to run for a while as well, but let's turn our attention to the markets. I mean, the markets of the day, of the month, of the year, I think, is South Korea, isn't it? Peter, since we last spoke, there's been extraordinary volatility in Korea. The Kospi 200 Volatility Index, sort of the equivalent of the S&P VIX, rose to 97 in June. It's trading now just below 70, so the volatility has come down a bit, but you have to bear in mind that the Kospi VIX was 29 at the end of 2025, so still pretty elevated volatility here. What are your thoughts, first of all, on what has happened so far, and also whether or not we're near the end of maybe some of these forced liquidations that we've been seeing on highly leveraged ETFs?
Right. Well, this is by far the most volatile period for the stock market outside of a financial crisis. We have a pretty good bull market, as we mentioned already. But in South Korea, we have a triple combination of retail fervor, AI theme based on the semiconductor sector, and then we got the leverage ETF, which is like a turbo boost that has amplified market movement. So all three combined is leading to this amazing period of volatility. It's starting to calm down because the government has stepped in, admitted their policy mistake of even allowing for these single stock leverage ETFs. But a point I probably have been making for a while now is that, that goes to confirm that we're in an era where stock market is now being treated as a bit of an online casino. Leverage ETFs is not just unique to Korea. It actually originated from Hong Kong. Now the US is doing it. And South Korean government sort of belatedly and reluctantly allowed this to try to keep the capital from flowing out of the country, which has led to a significant weakening of the currency. But, they've probably miscalculated the demand for these products by these very aggressive Korean retail investors.
How the Korean government has obviously been at the forefront of trying to encourage long-term investment in the market. It's been a stated policy, hasn't it, of the current government, and also they've had this value up program, the corporate value up program, which has been going on now for a couple of years. How much has this all been damaged by what we've seen over the last sort of couple of months?
Very damaging. I mean, just at a time when Korea is trying to be more mature, stable stock market for those aging population that's willing to try to look at stock market as a long-term investment vehicle. Now you have this very, very distracting element of AI, which is, in itself a pretty big theme in itself, but then you almost pouring gasoline over a bonfire that amplify the market movement. So it's very damaging, and I think it's very ironic that Korean government is trying to do this long-term investment culture cultivation just at a time when the whole rest of the world is almost sinking to our levels. So it is ironic. If we tried to do this 10 years ago, we probably would have had a much better success of it.
Yeah. And are retail investors, are they blaming the government? Are they blaming the regulators? When retail investors lose a lot of money, they're always looking for someone to blame, aren't they? Is it affecting the standing of the government itself here?
You're absolutely right. I mean, not just retail investors, right? Even institutional investors will blame their losses on anybody else but them. You have the new government that's been riding on a very, very high approvals rating since coming into the office over a year ago. Now at the lowest ratings since coming into office. I'm hoping that this is all part of a lesson, rather than blaming on the policymakers, that, you dabble in these exotic financial products, you got to bear the consequences. And I don't want to sound Machiavellian about it, but, it's a necessary part of being more mature, and hopefully it'll be a lesson for the better for what the market reform is supposedly trying to do.
I mean, you said this is the biggest moves we're seeing outside of a financial crisis. I'm wondering, is this a crisis itself, what we've been seeing happening in Korea? And if so, is the crisis now over? Has the fire been contained?
Yeah, well, it's definitely a sentiment crisis. But fortunately, this current market rally has been driven by earnings. The semicon and other sectors, earnings been very good, as it has been in the U.S. The valuations based on forward-looking earnings next year still at 8 times earnings. So it's not one of those retail-driven fervor that the bubble's bursting and then you have to wait for 2-3 years for it to recover, because it's true earnings-driven rally. Unfortunately, the short-term sentiment went ahead of itself. Now we probably need a bit of a consolidation to get the leverage out of the system. But I'm very optimistic that once the sentiment crisis is over, we'll get back to fundamentals.
I mean, the markets, as you mentioned, it's trading on very low forward earnings now, isn't it? So is that attracting institutional investors at least back into the market?
Yeah, interestingly, or not surprisingly, that the foreign institutional investors have been selling into this rally for quite a while now. So I'm hoping that the valuations will now attract those investors back. And perhaps the change of leadership is what's required typically. But once again, Korean retail investors has been the driver from 2 years ago. Them learning about the virtues of long-term investing, to me, is what will get the market on a sustained rally beyond the next few months.
I mean, Mark, this is a lesson for other markets as well, isn't it? Because it's not just South Korea that's been boosted by AI spending and the semiconductor boom that we're seeing that's been associated with that. It's happening in markets around the region and over in the US as well.
Yeah, well, to say the least, and we see it already. And of course, it's reacted in another way too. For example, TSMC and Sony are going to spend about $6.5 billion on an image sensor plant in Japan, partly in reaction to the strength of Samsung and of course rivals in China in this area. Now, admittedly, Taiwan and Japan have a history of partnership. It's often been an unbalanced partnership, but nonetheless, it's reacting in all different ways. So I think everybody's looking at this. Hong Kong, in that sense, we don't quite have that situation. We have other situations, but not that so much.
I mean, the Hong Kong regulators learnt their lesson maybe several years ago, didn't they, in terms of allowing leveraged products. They're very, very cautious now to go and do that again.
Yeah, absolutely. I mean, they've loosened some of the regulations a little bit to attract more investment from the mainland, obviously, in many areas and IPOs and so on, but it's still pretty strict.
Barry, what about the US? I mean, the AI merry-go-rounds continues to spin over there, doesn't it? The US stocks almost at a record high. They hit a record high last week, came off a bit overnight, but we've still got all these finance issues going on and questions of how much firms are spending on AI and how much money they need to raise to pay for that. Just overnight, we heard about Intel is going to be offering $15 billion in common stock. NVIDIA apparently has reached a deal with some big Wall Street firms to try and raise $500 billion to fund its AI infrastructure sort of build out. I mean, this continues there as well.
Well, that's for sure. But I'm not particularly pessimistic about the outlook concerning AI. There is so much public discussion, pro and con, about these data centers. This is not something that is happening in the dark. There's a lot of sunlight. Texas, which is very friendly to data centers, the governor, a Republican, now wants to have open hearings about how much electricity is going to be used. So what you've got, of course, is a race, a real race between the high-tech companies, almost all of them based in the Silicon Valley. But the market, Peter, is broader than that, and the rally has been broader than that. You find a lot of industrials doing very well. Look at Caterpillar, look at General Motors. I mean, yes, there's been volatility, so it's not all AI in the United States market.
Mm. You may be familiar, Barry, with the Buffett indicator, which is a measure of the stock market value invented by Warren Buffett. He basically looks at the whole value of the whole US market as a percentage of GDP on the basis that in the longer term, corporate earnings can't grow faster than the economy itself. They can't become more than 100% of the economy. So if you look at the Buffett indicator, which is the value of all US corporate stocks, it's now over 400% of GDP. Now, Warren Buffett starts to get concerned when it rises above 100. Just to compare that, just before the pandemic, it reached 244%. At the peak of the dot-com bubble, it got to 204%. And before the 1987 stock market crash, it was 74%. And just a reminder, it's now over 400% of GDP. You can look at other valuation indicators as well, like the long-term inflation-adjusted sort of earnings, all flashing red lights. Are there concerns about just how inflated the US market is becoming?
Sure there are. And I'm sorry that Warren, in his twilight years, is not commenting about that massive disparity between his favored indicator and what the data now reads. What a pity. But I thought you were going to ask me about Greg Abel, the Canadian, who's taken some of that $340 billion of cash and gotten rich for Berkshire Hathaway, mostly by buying Google.
I was going to say, so what's he spending it on?
He's part of the AI, isn't he?
What's he spending it on? He's got this big pile of cash that is inherited that Warren Buffett has carefully squirreled away over the years because he thinks the market is too expensive to buy. He always says you should be buying when everyone is fearful and selling when everyone is greedy. What's Abel spending it on?
Well, I think Google, if you look at those second quarter statistics, he bought a lot of Google and made tremendous amounts of money for Berkshire Hathaway. But of course, that $340 billion or whatever the number is, it rises so quickly. That was really what Warren was thinking of, buying companies. He hasn't found any companies to buy in that price range. So Greg Abel steps in and says, and by the way, he's now the CEO. He's making the decisions, saying, let's get into the market. So he did.
Peter, what do you make of the US market? It's at record highs. It seems to go to record highs every time Donald Trump says something about there being close to a deal in the Middle East. Except we keep hearing that and we don't get a deal. It seems to be also related to the oil price. At the moment, we've got everything tech sector, tech related, rising. Semiconductor shares, software shares, AI related companies. Everything is going up at the moment. What do you make of it?
Yeah, I think, as I said, I don't think there's going to be an excessive or preemptive interest rate hike to derail this bull market. I think we're probably maybe third quarter into this thing. But my lesson in my career about asset bubbles is that the final quarter is usually the most fiercest. That actually forces the skeptics into capitulating. So I'm very, very wary about calling the peak early. Again, the current correction that we've had in the semiconductors is sort of comforting to me that we're not in that exuberant stage where people will just buy anything because it rises. So there is a little bit of a reality check, which makes me feel that it's more of a mid-cycle correction rather than something that signals a peak and that we're going to see some calamity. So I'm still pretty bullish, but a lot more cautious than I was a few months ago. I do think that the macro environment is what I've been calling a twilight. It's not really hot, but it's not cold either. And I think the central bank actions and the communications sort of reflect that, right? They're just sort of trying to find the middle ground without taking a real decisive action one direction or the other.
If it's not going to be rising interest rates that's going to derail this market, I know it's hard to time it, but what could the catalyst be that might cause a big correction or even a bear market in US stocks?
I'll go first on that. Go ahead, Peter.
Well, sorry.
I was going to say war in the Middle East. Something going catastrophically wrong with the Iran thing. Another action from the Israelis. Anything in the Middle East could derail things very quickly, suddenly.
There's a lot we can hang on to for that unexpected event. Yeah, absolutely.
I mean, Mark, when you think about it, I mean, if you look at the market, if you arrived from another planet and looked at the US stock market, you would think nothing has happened over the last 6 months. There hasn't been a war. There hasn't been surging oil prices, inflation, expectations rising. All of this almost doesn't matter as far as the market's concerned, and it hasn't had an impact, and it's not going to have an impact.
Yeah, the others around the table can probably comment more intelligently upon this than I can. But it's remarkable. We've talked about this several times, and even what's going on in the Middle East right now, Strait of Hormuz. It's right around the corner. We're going to have a settlement any day now. I know that's probably true, but it doesn't seem, because the market seems to reflect that it is going to happen. There is going to be a settlement, or there's going to be something that they're more comfortable with going forward. Because otherwise, how could they be reaching these all-time highs every other day or every other week? It's strange. For me, anyway. Others know more about this than
Amen.
I do.
I mean, Barry, what do you make of where Trump is in the war? I mean, today's a Tuesday, so Tuesday he's normally talking about negotiating a settlement. I think on Wednesdays he's normally going to bomb the hell out of Iran again, and then on Thursday he's back to the negotiating table. Has he lost? Has he lost the initiative completely on this war? Because all he seems to be talking about now is not even restraining Iran's nuclear ambitions. It's just about getting the Strait of Hormuz open, which was open before he started this war.
Yeah, that's right. No, I think that this zigzag approach is a sign of possible desperation. He really wants a way out, and he hasn't found it. And certainly negotiating with the Iranians has proven to be absolutely something unprecedented for Donald Trump. Donald Trump prides himself on being able to negotiate with anybody. But I think the Iranians have proven him, I've never seen anything like this, might be his reply. So it's still a dangerous situation. You've got 50,000 Americans out there in this, very warm part of the world that president has constantly changed his objectives. So it remains dangerous.
Is it going to damage him in November in the midterm elections, do you think?
Of course, it has to. But he could, in the words of a magician, he could pull a rabbit out of the hat, which would change things instantly. This guy, as a politician, is not to be minimized. He is a very clever, savvy politician. Why does he talk to journalists every day? Because he's looking for them to reflect what the public's talking about. So this guy is well informed. He may not be an intellectual, he may not be a strategic thinker, but he's a savvy politician.
Mark, do you agree with that? Or do you think the Republicans are maybe in big trouble in November?
Well, they're in trouble. The big trouble is, Barry can comment on this as well. It's difficult to make it too big because of the nature of what's happened to elections in the various districts that are actually in competition. There are very few seats that are really competitive in the House of Representatives. So we're talking about a small number. So if the Democrats do well, yes, they can take control, but they're not going to have 30 seats, even, or 40 seats or 50 seats or whatever. Probably not anyway. So it's a different situation, but certainly it makes it a very difficult situation. But I agree with you. Even some of his strongest critics, like AOC, Alexandria Ocasio-Cortez, again praised him for his communication skills, for being able to pivot. She wasn't being friendly toward him, but she was recognizing that just what Barry said. He seemed to be able to respond to this. Is this going to last forever? Well, a lot of us have kept thinking it's not, but it keeps surprising us. So, the run up to the elections are going to be particularly, I think, fraught, and we're going to have even greater drama as we approach November.
Okay. Peter, one other markets thing I want to talk to you about, the Japanese yen. Since we saw that currency intervention last month between the US and Japan, which was the first joint yen buying coordination since 1998, the yen's given up roughly half of its gains since then. What lessons are we learning from what we've seen here in terms of the intervention in the currency market and whether it's going to have the desired effect?
Well, as far as Japan goes, is probably one other concern in the corner of my mind that I watch very closely because there are a lot of things happening over there that I don't feel very comfortable about. We just talked about how the Fed should be a little more hawkish, but they are, for political or other reasons, they are remaining restrained from that posture. But I think Japan is an entirely different story. They have still a lot of the structural issues they've had for 20, 30 years in terms of population, in terms of lack of growth and banking sector issues. And they're having to hike rates at a time when they don't want to. They're not in a position to be hiking too aggressive, but yet they are. So I'm very concerned about the BOJ's action and its intentions and how the market will react. And whether this fabled yen carry, how that's going to impact on capital flows. Impact on the currency. So I'm very worried about Japan because there are a lot of things that's happening there that I don't think many analysts fully grasp. And again, at a time of a large enough economy that is having to take these policy actions, it's not something that we see in any other part of the world.
The problems that you mention are not fixed, though, are they, by this currency intervention? It doesn't deal with any of those underlying problems.
No, I mean, they still have massive debt issues, the banking sector that's not functioning that well yet, population declining, and you have the currency that, by the way, a couple of years ago, they tried to engineer weakening. Now they're trying to stop it from weakening. I mean, it's not talk about a zigzag policy. I don't really know what they're hoping to achieve nowadays.
Well, another issue is the Takichi government is an expansionary fiscal stance.
Right.
And, they have to demonstrate fiscal discipline, we think, and her government is doing the opposite. So that's not exactly a good sign. Another thing which was just mentioned in the Japan Times, whether probably true, I guess, Toyota Motor is now basing an assumed exchange rate for the year ending March 2027 as 160 yen to the dollar. Raised it from 150. So do they know something we don't know? We don't know, but that's not a stronger yen.
I mean, Barry, what about the US Treasury? Is it becoming more interventionist now? Are we going to see more of this? Maybe not just in Japan, but perhaps in other countries that have weak currencies at the moment that Scott Bessent doesn't like.
Well, I don't think so. I think that he's got a special relationship with Japan. I was surprised to hear that he has traveled 40 to 50 times to Japan in his career. So I think that he has a soft spot for Japan and feels that he knows it quite well. But I think the question you raised, Peter, is the right one. It's not working as well as it had been planned. So will there be another intervention? Who knows?
What's South Korea's stance on this, Peter? There was sort of rumours that South Korea was involved in the intervention at one point. I don't know if that's true or not, but what's its stance on this? Because you could imagine, I mean, the Korean won this year has been particularly weak, hasn't it? Although it has rebounded recently. I mean, is that another area that's ripe for intervention?
Yeah, well, so South Korea has been engaged in this currency swap with not only with the U.S., but many other countries over the past 10, 15 years to try to safeguard unintentional movements in the currency. So this is not unknown territory for South Korea. I suspect that we had our own currency that was weakening for capital flow reasons rather than trade flows. So one of the theories is that the U.S.'s intervention with the yen has helped the won try to get that strength back, which has strengthened 8% around the same time. So Korea doesn't have these structural issues, the government debt or the massive balance sheet by the central bank, or not yet the population shrinkage that Japan has. So I've always said that Korea can learn a lot from Japan, both its ills and positives, and hopefully, the South Korean government can steal itself these inconsistent policies that we're seeing from Japan. That's maybe another lesson for us.
Okay, well, look, thank you all very much. We've covered a lot of ground there. Very interesting to hear your comments. You heard Peter Kim, who is Head of Global Investment Strategy at the KB Financial Group in Seoul. Mark Michelson, who is Chairman of the Asia CEO Forum at IMA Asia. And over in Washington, D.C., our US economics correspondent, writer and broadcaster, Barry Wood.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thank you very much for listening this morning. Don't forget to take a look at my daily Asia newsletter, which has the latest business and finance news from the Asia Pacific region. You'll find that at peterlewismoneytalk.substack.com. Please come back tomorrow. Joining me then are Richard Harris, Chief Executive Officer at Port Shelter Investment Management, and Sunil Kashyap, who is Director of FinMet. And with a view from Japan is John Byrne, Principal Economist at the Asian Development Bank. Have a great day.
Money Talk